And I think great examples of like fat apps, I think Hyperliquid is a great example, but that's also where I think, in my opinion, these things start to merge. So you have a fat app and a fat protocol. I think the fat application eventually becomes a protocol too, because it's great to be the underlying protocol and have other things built on top of you. So if you could build a fat app and then build a protocol around that, I think is actually a very smart idea. And that's what we're seeing with Hyperliquid, with Hyper EVM. They built obviously the Hyper core sort of perp trading / spot trading first, and now they're building the protocol side of things.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show is an investor-driven conversation with a prominent research partner from the crypto-native fund, Maven 11. In this episode, we discuss where Maven 11 plans to deploy capital and why they have conviction to invest in sectors they describe as opinionated applications, extensions of existing ecosystems, consumer apps, and more broadly in DeFi, such as stablecoins and payments. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. If you've ever wondered what financial freedom looks like in the age of AI, meet Newton, a smart, secure way to empower AI agents to work for you without giving them custody of your assets, for a world beyond interfaces, built for autonomous finance within your own tailor-made set of guardrails. Follow Magic Newton on X and get ready to try Newton soon. Maple Finance is one of my favorite products in DeFi. It is a gateway to sustainable real yield powered by over $1 billion in AUM across USDC and BTC products. And now with Syrup USDC by Maple, anyone can earn institutional grade yield. For deposits of $1,000 or more now through May 31st, Syrup USDC holders have a shot at a $300,000 grand prize expected to be drawn in November. The more you deposit, the higher your chances to win. Learn more at syrup.fi, and thanks to Maple for supporting us here at the Edge Podcast and Edge Newsletter. This episode is brought to you by SKALE, the next evolution in Layer 1 blockchains with a gas-free, invisible UX, instant finality, and robust security. SKALE allows for limitless scalability and has already saved its 50 million users over $11 billion in gas fees. Visit scale.space today and follow their journey on X at SKALE Network. Overwhelmed trying to manage your crypto and DeFi investments? Meet iYIELD, a free financial planning tool for crypto natives and yield farmers. iYIELD's dashboard compares returns from your DeFi positions side by side, providing clarity to help you make better decisions. iYIELD supports a growing list of over 16,000 tokens and 40 of the top DeFi and staking protocols across 17 blockchains, including Ethereum L2s. The best part is that iYIELD is 100% free, anonymous, and there are no ads. Check out iYIELD.com today to take control of your financial future. Hey folks, I wanted to tell you a bit about our sponsor, PYTH Oracles, your go-to source for smarter data to power smarter contracts. PYTH delivers real-time market data for crypto, equities, FX, and commodities to over 80 blockchains. With 120 plus major market participants like Jane Street, Binance, and CBOE, PYTH ensures secure, low-latency feeds trusted by 430 DeFi apps. You can learn more about PYTH by going to pyth.network, and thanks to the PYTH community for supporting us here at the Edge Podcast and Edge Newsletter. All right, let's introduce Maz, research partner at Maven 11. Maz, welcome to the Edge Podcast. How are you doing?
Doing great. Market isn't, but I'm doing great. Thanks for having me.
For years, Nomadic and I have followed your team at Maven 11. There's no doubt you've made some legendary investments, teams like Celestia, Maple Finance, Redstone Oracles. And so being early to some of the biggest names in the space, DeFi, infrastructure in general, we're really excited to pick your brain on what is interesting to you. Where do you think the puck is going next? And so hopefully today we can talk about, what's going to be big in 2025 and beyond. And also congrats on the Fund 3 you guys raised recently. I believe you raised around $107 million, so well-deserved there. But why don't we talk a little bit more then about the thesis behind Maven 11. Like maybe you can give a little bit more detail around the background I mentioned.
Yeah, happy to give you, I won't call it a boilerplate intro, but happy to give you sort of some background on the fund itself. So you're right when you said early. We like to do stuff very early. And we're also an early fund in this space. So it was founded in 2015, which is obviously at this point almost 10 years ago, almost to the exact date. The first fund wasn't until 2017 though, and that's what we were sort of branded as the Maven 11 2017 fund. That fund, however, was more of like an open-ended hedge fund. There wasn't much venture investments to be done back then. It was mostly like Bitcoin miners. I know BCAP's early funds are all like Bitcoin miners that were buying up, which is a very cool thing to do, but also something very difficult to do, especially in Europe where most of these Bitcoin miners were not at. They were either in the US or obviously in China specifically, Kazakhstan and so on. They started changing like 2019, 2020. There was a bunch more stuff that were actually eventually investable, and we started pivoting into that. We just enjoyed doing early stage investments, coming up with a thesis, implementing that thesis, and investing in it, and then working with teams over 5 to 6 years. So a lot of our work as like investors is also just helping people build the company. For my specifically being a research partner, helping companies with mechanism design, for example. So that's probably the sort of, I would say, is the background of Maven 11 as a whole. Obviously, we've developed quite a bit since then. Now on the third fund. But it's always been sort of the same idea. We want to do stuff early. We want to work together with people for a long time. And then we see where we go from there.
Can you tell us just a little bit more about yourself? Like what got you into the space? You know, I guess why do you enjoy doing what you do?
Yeah, happy to. I'd say I have a pretty unusual entrance into crypto. So I'm almost in my 30s. So I'm getting up in the years.
You're old, just to be clear. For our listeners, Nomadic and I are 26. We're 26 years old, right? Yeah.
Well, I look younger than you guys, so I hope you're not 26. But essentially what happened back then, this is 12 years ago now, 2025. So 2013, I was in high school. I was never a very studious type in high school, unless it was things that I loved. If it was something I loved studying, I was very, very attentive. This was one class where I was not in love with the subject. I think it was French, so I don't speak very good French to this day. But I had and if you're as old as me, so you two might know, a Kindle Fire, which was this little tablet. The one I had didn't have color, so it was colorless, but it did have access to the internet. And if you're also older, you also would know Reddit, which is still very popular today. And Reddit has these different types of subreddits where you can discuss different things that might be of interest to you. There was 2 subreddits, r/Bitcoin and r/BTC. I think r/BTC at this point has become more of a Bitcoin Cash subreddit, even though they say they're not. I've ran into Bitcoin, r/Bitcoin, just scrolling through sort of the most popular subreddits. And I was like, damn, what the hell is this? Something interesting is going on here. Took me to the Bitcoin Talk forums. So this is at the tail end when Satoshi and Nick Szabo and a bunch of legends were still posting on the forums and still active in the community. And I just fell in love, not with the technical aspect, but with sort of just the cyberpunkish nature of it and ethos of crypto. Found a guy on Local Bitcoins, met up with him and bought some Bitcoin and started using Kraken in 2014. So I was more in it just for the cyberpunk ethos and for trading. This changed because I moved to China in 2017, where I spent the next 6 years. And there I really sort of realized that, okay, there's actual real reasons for wanting a permissionless global network that anybody can interact with. And that experience kind of really sort of opened my eyes to that. And that was when I really wanted to understand sort of the technical side of it. And that took me to Twitter, where I sort of saw a lot of people post about extremely technical posts. And also just coin good, coin go up. I was missing sort of the in-between. So I started just writing stuff because I was reading white papers all day, looking for interesting projects. I think I wrote a post in 2021 on like, why do rollups need data availability? Which nobody had thought to sort of explain simply to the people of Twitter. And Mathiesen, who is one of the general partners of the fund, saw it and essentially DM'd me and said, yo, we're Celestia investors. It seems like your thesis in terms of scalability is pretty similar to ours. So why don't you come join the team? I did, came back to Europe, and it's been in Europe for the last 3 years now. And that's generally my history of sort of how I go into crypto, how I go into the technical aspect of it. But it's been a long trip so far.
Maz, can I ask a quick question just about Maven 11? Like, do you all work together in an office? I'm curious. Or are you fully remote?
We do have an office. So most of our employees are all in Europe, specifically in Amsterdam. We're not all Dutch. I'm not Dutch myself, and like half the team is not Dutch. But we do have an office in Amsterdam. And there's specific sort of aspects of the team that is in the office. Generally, the venture team is not, apart from like one time a week, because it is good to see each other and be socialized. But the amount of calls that we have to take and the amount of reading that I specifically have to do in writing doesn't lend itself very much to a busy office with a bunch of people walking around and talking. But the credit side, the liquid side, some of the lab stuff that we do with like searching and market making on-chain, and like the operational side is all in the office here in Amsterdam.
Given what you mentioned about the like cypherpunk movement that sort of drew you in and, you know, seeing an opportunity to build like uncensorable networks to like almost like reimagine applications, definitely money, but then eventually DeFi. Do you feel like the space has lost its way a bit? I feel like what originally drew me in is very similar to what you've described, and it like cuts like to the core of like who I am as a person. I'm very passionate about it. I could talk to a stranger about that, and I feel like that soul has been lost in fast money, specifically like the whole nihilistic meme coin pump movement over the last few years.
That's a great question, and I agree with like your general take on it. I will say though, while yes, a lot of that's been lost, I think there's just a natural evolution of more people getting into the space. The issue was that a lot of those people getting into the space has not had a real life experience. And I think at some point during our lives, especially with the way the world is going, most people would have an experience in their lives that will say, this is the reason why crypto has to exist. I had that early because I was in China. I think you might have had an experience in your life that were like, okay, this is why it matters. I just think most people that live their daily lives, especially if you're in a country that is, you know, relatively open and safe, you don't have a real life experience of like, this is why crypto is important. The only interaction you have with crypto is because, oh, I'm hearing people are making money here. I would like to make some more money. And that's their entrance into crypto rather than, oh, I need to transfer money back to my parents or my family that lives somewhere else. And MoneyGram is taking 12.5% or whatever it is from me. So I think most people, sadly, at least in the last few years, came into crypto not from the reason of needing permissionless networks, but from the reason of, oh, because it's permissionless and because there's no lot of the regulation and laws, it's very easy to trade here and make money. So I think, yes, I'd agree, but I also think most people will have this experience. I would hope, but also not hope, because that means we've gone down a very dark path. But that's the way I would look at this sort of cyberpunkish loss that we've had so far.
Maz, I want to get your take on maybe some shifting landscapes we're seeing within VC. So depending on when you got into crypto, you probably saw the rise of the ICO boom, and then this shift to almost like fully VC funding. And we're starting to see a little bit of a shift of the pendulum maybe back, maybe somewhere in the middle between those two things, with things like Echo emerging and Legion. These are, projects that allow basically anyone that's accredited to get into some of these investments at an early stage. You don't have to be part of a VC fund. So curious how Maven 11 is thinking about this. Is this anything that you're considering? Do you see this being maybe like a sort of a more permanent move, or where do you think the pendulum is going here?
I think it's more of a permanent move, 100%. And it is something that we actively encourage our portfolio companies to do. Specifically Echo. A lot of the Echo groups have extremely smart, extremely engaged, and very sort of invested people in crypto in those groups. So it is something we're actively encouraging. We do want to be we've been thinking about doing our own group, for example. I will say, though, I think people are underestimating the amount of lockups and time that, if you get in early, that you do have. So I do think that side of the coin is highly underexplored for people. I think people just expect that, you invest early at a low valuation, and then, 5 months later, you collect the crops. It's not that simple, right? The coin might be launched, but you're still locked up and unvested, for example. And then also, I think maybe one issue with ICOs as a whole, and I think that is different now on Legion and Echo. Usually these are projects that have some VC funding to some extent. With ICOs, you have no checks and balances. And with venture capital involved, you do have checks and balances, and you do have people that are checking up and actively trying to help. We're not just trying to extract from the ecosystem, as much as some people like to sort of say that. So I do think it's great, but I do think people are generally underestimating sort of the general idea of what it is to be a venture investor and the amount of work that actually goes into that, both on the project, but also on the venture side.
Maz, can you draw that first point out a little bit more? Because this is something I've seen on crypto Twitter. There's been this massive kind of lashing out against VCs. And I think there's this general assumption that you're just printing money and it's easy. But when you say things like there's a 1-year lockup and then typically another 3-year linear vest after that, where you can not get your money for a total of 4 years in many instances, recoup your investment from these projects. Maybe just explain that a little bit more in depth, what we mean by a lockup and this vesting terms.
Yeah. So generally when you do an investment, there'll be terms associated with that, and within that there'll be, as you said, a lockup or a vest, and that's generally just to avoid that immediately as token goes live, people immediately dump it on the open market. You don't want that to happen at all. There are ways to get around this, if you want to call it that, for some people. They can sell OTC. Obviously, there will be a significant premium on this, and it'll be a lot. You won't get the live price that might be trading on Binance, for example. So this lockup means that in most cases, there is a caveat to that, especially with L1s that have staking where investors can stake locked tokens. I don't think this is great. I don't think this should be a thing. I do get it to some extent that why some VCs advocate for this, because they've been locked up, especially on the L1s. The development time is much longer, right? You're waiting maybe 3 or 4 years for the token and never to even go live. Then you have another 3-year lockup after the token goes live. So it could be 6-7 years, which is way longer time horizons than most funds. So I can get why some people would want to sell staking rewards, for example, and why they're not lock up. But in most cases, let's say any DeFi protocol, right? These tokens, you're locked up for 3 years. You might get some vesting. Some of them will start to invest, and you can start to maybe sell that and take some profit. But actually, I think what's very clear for most people is that most projects in crypto don't last that long. Most of them, end up failing, sadly, as sad as that is. There's a very small subset of applications, especially in DeFi, that have made it past that period of where the tokens are vested. So I think a lot of funds, especially the vintages from 2021, 2022, 2023 even, are in terrible positions, right? Most of them have not made any money. Obviously, I think if you look back at the older funds, so our fund one, if you look at some of the old A16C funds and some of these earlier funds, done incredibly well, right? The market has gone up so much. But if you launched the fund in 2021 and any years after that, I think in most cases you're not looking very good. And maybe more than half of your portfolio already hasn't made it anywhere. So yeah, there's a lot of work sort of behind the scenes that I don't think most people do understand. I can understand, obviously, especially when people sell OTC, I can see that being especially irritating, especially if you got another 10 million valuation, but token and L1 is trading at 2 billion and you're selling maybe for a 50% haircut. That's still ridiculous. So I do understand that. And it is great with obviously Legion and Echo that people can get in early if they want to. I just think that people have to be aware that, yeah, you're not going to see these funds for a very, very long time, if at all. But at least Echo and Legion, you do have checks and balances, which is great. And I think a lot of the people on these platforms, especially Echo, have done angel investments before. So in that sense, they're aware of what they're walking into.
What has been your thoughts on the high FTV criticism over the last few years? like for anyone who has never understood the detail around that, just imagine you have a team that raises at a seed round valuation of, let's say, 30 million, and then they do another round later, and we'll call this one a strategic round at 100 million, and then they end up doing another one at, let's say, 200 or even 500 million, and then eventually they do one at 2 billion. I think people who maybe aren't in the types of meetings that I guess all of us would be in, they don't realize that, like, I mean, each and every round legitimizes that valuation in the eyes of a lot of folks, even though there's a lot of criticism about them then launching a token at an FDV that high. And so I feel like for all the criticism that was out there, there was clearly demand to buy those tokens at a high valuation. And so I think the end result of all of this has been that demand eventually ran dry, and we were seeing tokens launch at, let's say, 10 to 20 billion. I mean, as little as a few billion. And then you would just see a slow bleed off. Instead of, like, in the ICO days, you saw the crazy spike and then maybe it sold off after, but, like, I mean, there was so little regulation or, like, rules to follow at that point that, like, maybe it would, like, continue upwards until, of course, some insider dumped on it. So this, I mean to call out, this has been a new phenomenon of a problem in the space. The thing is it got called out very vocally, and then I do think that the meme coin mania that followed was like the market's reaction, like a nihilistic reaction to, like, well, if we're going to get screwed and not have a chance to get into tokens earlier, then we're ultimately going to, like, bet on total dog shit, which is the meme coin mania. But anyways, I'm wondering, as an investor, like, did you see a fix there? Or, like, what was Maven 11 doing during this time? I know you bet early, but, like, I mean, at some point, you're an investor looking for opportunities, and, like, there are bets to still take while this problem is, I think, seemingly getting worse and worse.
Yeah, I have a personal opinion from, like, just an active market participant for 10 years. And then I will say the high of 3 is bad. And I won't give Maven 11's perspective on this. I'll give what's just a general VC perspective of why these high of 3 launches were happening. And I think it's a pretty stupid reason, but I do understand why it was happening. So a lot of VCs were pushing projects to launch at high of 3s because obviously it looks great on the balance sheet. And if you have to go out and raise a new fund, if you could showcase multiples on that fund that you just deployed, it makes it a lot easier to raise funds from other people. And then the other reason, and it's maybe more in, like, dynamics and pricing, is that it seems a lot easier to keep a valuation up high than starting lower and go up. I think if you look at, like, some of the, like, sort of community funded or old school DeFi protocols, if those DeFi protocols have launched at a much higher FTV, I think they would be trading much higher today. But they started low, and that's great. Obviously, you can get people involved early. You have real community members that are extremely attached and associated with the project. But it is a lot harder to go up than it is to launch here and then stay in that sort of chasm. That's probably the two reasons that I think are the clearest ones here. I will say it's still a massive issue. And I, at least generally, I would advise people to launch as low as you humanly can. But there are reasons why people are pushing for the other side of that coin. But I think if you really want people to, like, at least in the community, to love your token, they need to be bought in early. Whether that is through Echo or Legion or community sales or airdrops. Airdrops I don't think are the greatest in this case, because you're incentivizing selling and not buying, which you would do with getting in people early. So that's probably the two sides of the coin that I would present.
Maz, I wonder if you can define a few terms for us. One is the FAT protocol thesis, and then the other is the FAT app thesis. So we've been in, I'd say, an era of the FAT protocol thesis, but there's many people calling for this FAT apps thesis. And maybe you can just break down what those are and what this kind of transition means, and curious ultimately how you and Maven 11 view this this kind of change, if you even believe there is one too.
Yeah, happy to. It's a little bit in the name, I'd say, but to expand on it, that protocol is generally what you'd look at like an Ethereum or Solana, these massive general L1s that are massive protocols, and you're building a bunch of apps on top of it, but most of the value is siphoned off to the L1 itself, whether that is through fees or through extractable value, MEV. That protocol is getting most of the value from the things built on top of it. And this is something we've seen a lot of, because all the beautiful aspects of blockchains is the fact that we can agree the things in time periods, so block times, which means we can do stuff atomically. So I could do stuff in between an Aave and a Maker and a cow swap and so on and so forth. And that sort of atomic agreed upon thing is super, super cool. And obviously some fee has to go to that protocol underneath for that. The other side of that coin is sort of the fat app thesis. And that goes back to the sort of fee MEV aspect that I just mentioned. A lot of these applications are, getting a ton of users to this protocol, but they're giving away so much of the value to the underlying protocol. I think this is especially clear with a Uniswap. Uniswap creates so much MEV on Ethereum that ebbs and flows throughout the protocol, but they really capture none of it, especially not for like the liquidity providers themselves. Like if you're LPing on Uniswap, it's not great. You're losing money, both because of block times and loss versus rebalancing and so on and so forth, bunch of very complex terms. So the reason why this fat app thing is a thing is that a lot of these apps, they want to actually be able to not necessarily extract, but they want to be able to profit from these things happening on top in their applications. And you just can't do that with how generalizable L1s or even generalizable L2s work today, because there's a proposer monopoly, that would be a sequencer on Arbitrum, or it'd be the Ethereum validators on Ethereum. And I think great examples of like fat apps, I think Hyperliquid is a great example, but that's also where I think, in my opinion, these things start to merge. So you have a fat app and a fat protocol. I think the fat application eventually becomes a protocol too, because it's great to be the underlying protocol and have other things built on top of you. So if you could build a fat app and then build a protocol around that, I think is actually a very smart idea. And that's what we're seeing with Hyperliquid, with Hyper EVM. They built obviously the Hyper core sort of perp trading / spot trading first, and now they're building the protocol side of things. We saw Aave, Maker exploring these things throughout the years. Uniswap now doing UNICHAIN. So it seems like all these very successful apps are realizing that if we don't build a protocol, it's very difficult for us to actually profit from the actual revenue that we're bringing in. So that's probably the way I would explain sort of the fat app and fat protocol thesis. And in terms of what we like to do, and this sort of fits in a little bit to what I call opinionated applications. So this is something I mentioned in our fundraising thread, and what I had written about in December. I wrote a pretty extensive article on this. And it's the idea that like if you actually want to build a better application, you generally have to make choices about how you want to serve the end user, or even aspects or actors that are key for that application to succeed. And I think we're starting to see this slowly happening with these larger, very successful applications that are coming out.
MANTLE is charting a course towards a future of enabling crypto access for everyone, with major endeavors to build MANTLE Banking and MANTLE Index 4. MANTLE Banking means a new crypto neobank that helps users spend, save, and invest across their fiat and crypto finances, all in one account. MANTLE Index 4 is a tokenized fund in partnership with one of the leading tokenization platforms in the market. You can think of MI4 as the S&P 500 of crypto. To learn more, check out group.mantle.xyz, and thanks to the MANTLE community for supporting us here at the Edge Podcast and Edge Newsletter. Before we expand further on applications today, going back to the fat protocol thesis, and I think what we've seen with L1's accruing value, since the ICO era, my one question is, do you see the L1s that did benefit from that? And I guess are like, let's say that they are like household established names, for example, Ethereum, Solana. Actually, let's just stick with those two for right now. With Ethereum and Solana, do you foresee them still continuing to benefit from that? Like, given this fat app thesis that you're expecting to play out. So I'm less keen on new L1s, generalizable L1s. I'm thinking about those that already have established network effects, or are they going to contract in terms of their value accrual that we saw over the years?
I think it depends on what kind of applications get built. I think if you look at Ethereum's value accrual, and sorry if you hold ETH as an asset, the value accrual to Ethereum as a whole has been going down. The same goes for Solana post meme coin mania. Obviously, the fees it was accruing during the meme coin mania was astronomical, and that I think tailors back to like that atomic thing, is that the applications that you can build, especially in DeFi, on Ethereum and Solana, are just great. You can build stuff that sort of ties together and routes together. If you look at some of the trades happening through a cow swap, the amount of routing into different types of liquidity providers, private and open, is just beautiful to watch. But it also, there's one side to it, is that like, depending on what application you are, let's say Uniswap, a Uniswap can't just move to its own chain, right? It needs liquidity to service traders, and that liquidity lives on Ethereum. And I think, especially with these large established L1s, liquidity is sort of king, but also decentralization is king. I think if you look at a large institution today, I don't think they would be comfortable putting, let's say, 5 billion on Solana, just because of the outages it's had in the past. And sort of even though it is somewhat decentralized, there is centralized aspects of it. And there's specifically the MEV aspect of Solana as well that is very non-transparent. On Ethereum, I think it's really only L1 today where an institution is comfortable enough to put large amounts of capital on. And I think that's one of the biggest strengths, is that having lived on for so long and have been so decentralized, people just trust it. And I think in financial markets, trust is extremely important, especially when it comes to ensuring that your assets are safe. I wouldn't want to put my money in a bank that started 2 years ago and I don't know where it's what they're doing behind the scenes. With Ethereum, I can sort of know and trust that band, and it's accrues so much liquidity. Obviously, they have issues with technical baggage, and that's where Solana is great. They're more centralized. The development team, they can work way faster and make upgrades. This Ethereum is so decentralized. You have so many clients, both execution and consensus clients, and making any changes takes months, if not years. So it's very hard for Ethereum to keep up with all the demand. But I will say most of the L1s today could handle most of the demand we're seeing in crypto. There isn't that many people in crypto. And a lot of them are just in centralized exchanges, sadly.
Maz, given everything that you just explained, do you think that this is fixable then for an L1 like Ethereum that is as established as it is, or like a Solana that has the sort of, viral network effects that it does?
I will say it is. I think obviously a lot of this is up to the app developers, right, to bring back users to the platforms. Obviously, they're quite constrained if they want to build applications that are tailored specifically to those new users, unless we're just happy with what exists already on Ethereum and Solana. What I like is sort of extensions of Solana and Ethereum, and I think a lot of work can be done here. A lot of you, if you're around late last year, there was a lot of talk about based rollups on Ethereum. And this is sort of a way to sort of accommodate some of these applications that might want to customize or control different aspects of building their underlying infrastructure. There's also on Solana, obviously, extensions, network extensions. Our network extensions, they're rollups. So that there are sort of fixes to this, because at the end of the day, it's up to the application developer to build applications that users want to come use. And obviously that is quite difficult to do in ways that are different from what's being done now on Ethereum and Solana. Obviously, DeFi we've built has been great. The trading experience on Solana specifically is great. I say on Ethereum, sort of the technical baggage will make it quite difficult to accommodate heavy trading like we've seen on Solana. That's just not impossible. We saw how Ethereum works doing heavy trading, and it's our fees that happened on there. But I will say it's fixable. And I think extensions of this will continue to see to still pop up. I think on Solana you have Magic Block, for example, who are building these sort of ephemeral rollups, or base rollups, or whatever you want to call them. That we have on Ethereum with things like Spire and Tycho and so on. But I think what you see with these sort of stagnant L1s, and I think this happens to all L1s, even Solana, is that teams outside of the main development teams are actually the ones that push forward the L1s as a whole. And I think that's totally fine, right? We're all trying to build permissionless blockchains, and if people outside of the core teams can help accelerate those L1s, I'd say that's great. And I think that's the hope that Ethereum and Solana has to have, is that their communities are so strong on the developer side compared to any other L1s out there that they can just out-accelerate and out-develop, especially for developers that are looking to build sort of the next stage of applications.
Maz, I want to go back to something you were saying a bit earlier. It's almost like a personal gripe of mine. It's like within crypto, Twitter, let's call it, I feel like everybody screams for, either or a black and white answer. And I think this kind of goes back to we heard this kind of rally cry coming up recently, apps over infra. Basically, everybody was sick of infra, and they're like, now everybody just needs to pivot into building apps. But I think what you propose and what you're illuminating is an app developer also needs to maybe be an infra developer, or an infra developer maybe needs to be an app developer. I think there's much more in the middle here in nuance, because you're kind of shining a light on, hey, there's a bigger piece of the pie to capture if you're an app developer that understands the infra, right? Yeah. Is that fair to say?
That's very fair to say. I think I coined it app infra. I think I used the sort of Dragon Ball Z when they merge into one, to sort of explain it to you.
We can show that on the screen. We probably just did if you're listening to this.
Magic. I think the beauty of infrastructure is that you could tailor it to sort of an application. And if you do that correctly, and obviously this is very difficult, and obviously there's a bunch of tooling being built so that you don't have to be an infra developer like you mentioned, but you can just be an application developer, and you can then tweak things with a slider, for example. Obviously that's not quite there yet in terms of developer experience, but if you do have the expertise to build infra and build good applications, which is very difficult, and I think very few people succeed here, Hyperliquid is one. And I'm sorry to say the name over and over again, but I think it's a perfect example of sort of the merging of an app and infra to just make the application much, much better. And I think that's what you're going to see has to happen to sort of build this next stage of applications, is that you have to merge application with infra. And obviously Cosmos did this, I say, too early. And that's a common tripe with Cosmos, at least the ecosystem as a whole, is that they do stuff, they just do it way too early. And then they don't market it very well. But obviously the application-specific chain thing, app chain thesis, was a real thing for years on Solana, but in the Cosmos ecosystem. It hasn't quite played out well, but rather it's succeeded on Ethereum now, on top of Ethereum rather. And I think that's what we're going to continue to see, is that if you really want to build stuff that is great and is different and provide a good user experience, you can just not be on a generalizable chain. It's impossible, especially if you want to profit from building that, especially if you're carrying a lot of DeFi activity over to your application.
Maz, we've sort of talked about a few of these things, but with your announcement of Maven's third fund, you highlighted some things in a tweet that you're personally really excited to deploy into. And again, we've talked about a few of these. I'll just list them all, but you mentioned opinionated applications. You say extensions of existing ecosystems, consumer apps, payments, stablecoins, and DeFi. I want to break a few of these down and maybe give us some examples of things that exist today that kind of fit these categories, but ultimately what will this stuff look in your eyes kind of going forward? So
I think in terms of concrete examples of applications being extremely opinionated about how they do things, you have to look at ordering specifically. So this is the order of which transactions get put into your block, which is very important for stuff like MEV, but also important for trade execution if you're a trader. And here I think a good example is Hyperliquid. Hyperliquid wouldn't exist the way it does now if it was in a smart contract on Ethereum, because they cannot enforce and control ordering within an Ethereum block specifically for themselves, unless they want to be completely non-composable. But then why are you on Ethereum to begin with, and why are you constrained by the output or throughput of Ethereum? So what Hyperliquid does is that they prioritize specific types of actions / transactions. What they specifically prioritize within the top of the Hyperliquid block is cancellations. So if I could cancel on my order, that gets prioritized before anything else. And also post-only maker orders. This is specifically great for market makers. And obviously having efficient and good market making makes it so you have way better trading experiences and better execution for your actual traders. And that's a key aspect if you're trying to build a decentralized perpetual exchange to combat the centralized exchanges that we have today. And also what they've done in terms of wallet infrastructure. So if you've traded on Hyperliquid, you'll know that you're not signing every single trade you're making. You're signing in once, and then it's just click and play. And they wouldn't be able to do that in most other cases as on-chain Level 1. So I'd say that's a good example of what I mean by an opinionated application. Obviously, this is very hard to build, and very few teams can do it. But if you can do it, there's clear sort of PMF to be found still.
Hey folks, I want to tell you about our sponsor, GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi.
Egg. A quite astonishing commodity. The cause of your desire. Egg. Which fills the inner void. Egg.
Eggs are pretty epic, but you know what's more epic? Paying for them with crypto. Borrow, earn, and now pay with MOONWELL.
Say hello to Puffer UNIFI. Puffer Finance is expanding beyond native liquid restaking with new products such as UNIFI-based ROLLUP and UNIFI pre-confirmations AVS. UNIFI is not just another L2. UNIFI is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer UNIFI. Puffer UNIFI is fast, capable of sub-second transactions. UNIFI also has boosted Puffer points, which means if you bridge assets, you earn boosted Puffer points and rewards from dApps on UNIFI. Puffer's core products mean a bright future for Ethereum. Learn more at puffer.fi. The next sector that you called out in the announcement of Maven 11's third fund is extensions of existing ecosystems. Can you explain what you mean by this? And then if you have any examples that fit the criteria for this.
Yes, it is sort of connects back to what I mentioned earlier to some extent, is that these existing ecosystems are quite stagnant in development. And it's very hard to build stuff on them that goes beyond what we have already. In most cases, you'd want maybe some customization, maybe you want more throughput, but you still want to be associated with these ecosystems, either because there's stuff on there that you want to be composable with, or that you want to touch, maybe that's liquidity. So extension of these ecosystems, I think good examples of this are rollups, but I say rollups in most cases are more sort of siphoning away. So most rollups, I'd say, are just their own ones, right? They're extracting all of the value. But a base rollup on Ethereum, which is sort of supposed to be very composable and synchronous with the underlying layer, obviously gives away some of that value again back to the L1. and also allows app developers to either get more throughput, maybe make customization changes, but still sort of retain that either association or composability with the underlying layer. I think good examples of this already that I'll shout out are probably a Tycho, which is a base rollup on Ethereum, but also Spire, who right now I think are working on some very cool like L3 based L3s, and obviously we're getting a lot of layers now. But let's say you're on Base, and you want to be associated with Base, but Base can't support your extreme throughput that you might have, or maybe you want to make some customization changes. Well, you could be an L3 that is sequenced by the Base sequencer, and that could be something that you might be interested in. On Solana, we also have similar things here. I'd say a Magic Block are doing some cool stuff here, specifically tailored towards, I'd say, consumer applications, but even DeFi applications that might want to do specific ordering stuff. PYTH are a great example here, where you sort of can do that ordering and you kind of have to do that ordering. So that's the way I would put extensions of existing ecosystems. Because like we're not really interested in just backing yet another generalizable chain. I think that has sort of run its course. I think most of the infrastructure is ready to be used to build real applications, especially some of these newer, very sort of decent and high throughput chains. I don't think we need more ones. I think it has to sort of merge into app/infra for that to really change, or it has to be extensions of what you have already. So that's the way I would sort of coin extensions of existing ecosystems.
It's probably a good segue then, because the third thing you call out is consumer apps, which, people have been calling for this to happen forever too. And I find consumer apps in crypto, Web3, whatever you want to call it, extremely difficult to diligence, like what's going to be a hit, what's not. So would love to pick your brain on how you're looking at this sector of consumer apps.
Yeah, I think it's been funny and kind of weird to just say, oh, we just want to invest in apps now. Apps, because infrastructure is no longer launching at high FTV. So a lot of people have been saying, oh, we want to do apps, we want to do consumer apps. I think the weird part of just saying that is that I think most consumers in the current sort of paradigm don't want to interact with anything crypto at all. So I think if you're building anything consumer, it has to be because there's real tangible reasons why you'd want to use a blockchain. Maybe that is like micropayments. Maybe that is to incentivize some supply side of something, like a grass, right? They incentivized people to run nodes, and then they'll get, because they already have the demand somewhere. I think just doing consumer investing consumer because, oh, we need apps is weird. I think if you actually want new entrants into the space, you probably have to build stuff that is like, doesn't even feel like it's crypto. I'm not signing anything. So like embedded wallets like Privy are great here. So we've seen like some social apps here, although in most cases, I don't really see the reasons why they need to be crypto related. I think most of them have failed quite broadly. And I think most people don't necessarily care about the decentralization of their social network, which as sad as that is to say, but that's just the reality. I think we have some good examples of like real consumer applications that have reasons to use blockchain, whether that's for on and off ramping and doing micropayments. Prediction markets, great success. We were able to predict that Trump was going to be the president while everybody was saying he was not going to be. I think that's a great use case. And you're seeing so many prediction markets, probably too many. I think if you're investing in prediction markets now, a lot of them are going to fail. And there's going to be a lot more of them. But I think what we see with Polymarket has been a great example of this. I think there's also like this one thing I saw was like Blackbird. It was like a Resi type application for restaurants in New York, where you just sort of incentivize going to specific restaurants, I think. Interesting use case. I think they have quite a lot of users. I don't think it feels like a crypto application at all, but there's reasons why there's crypto applications underneath. And I think that is what has to change. Earn applications, I think it ties a little bit into DeFi, right? But like earn applications, obviously Celsius had real demand. What they were doing with the funds on the back end, not great, pretty bad, very criminal. But there's real demand for yields that is much higher than what you'd get from just depositing your money into a bank. That much is very clear. It just can't and shouldn't feel like crypto on the front ends of things. So that's what I'll say in terms of like consumer applications. We're not just going to do consumer because we have to. I think in most cases it has to be a completely different type of developer that in most cases isn't in crypto yet. I think a lot of the DeFi developers are very different than the type of developer that would build consumer applications. And I think a lot of the consumer developers are not into or don't like crypto. I think that is starting to change though, with specifically the provenance of stablecoins and DeFi seeing actual real use cases.
I think this goes back to financial use cases are where the product market fit has been in crypto, specifically DeFi, which is funny enough, it will be kind of like the broader final topic that you covered in that announcement. So you called out payments, stablecoins, and DeFi. And I think kind of just led into this that there's only so much that you can build on a blockchain or with crypto assets that really makes sense. I mean, I feel like the one major app you called out was prediction markets. And like, if someone said to me like, oh yeah, DeFi and prediction markets, I'm like, whoa. Prediction markets fits under the umbrella that is DeFi. Like it's ultimately, you're betting and it's about what? Like it's about being able to make more money, to be able to, transfer money in so that you can make a bet there. So going back to some of the like purest uses, I think, of DeFi, why don't we talk first about stablecoins? I think stablecoins has been like a breakout in terms of mainstream success within crypto. It's bled over into like mainstream outside of crypto. It seems like all of the major banks in the world are thinking about it. Countries are thinking about it. So yeah, what are your thoughts there on stablecoins? Like what's the next most exciting trend or trends that you see there?
Yeah, I think it's been by far the clearest PMF for blockchains after sort of the initial, let's say, wave of DeFi. Obviously, it was an inevitability, right? You do want stable assets to trade against for assets on chain. So that's sort of how it all came to be and started. It's a great way to on-ramp as well. And you do want sometimes stable assets because crypto assets are extremely unstable, as I think we're all aware of. But if you look at like the way blockchains work, I think blockchains as a concept is what makes stablecoins work great. So like blockchains are permissionless. They give you provenance that can be agreed upon by a set of actors that in most cases are quite decentralized all around the world, which means we have a global clock that can agree on something being true or not, which makes it extremely efficient for settling things. So stablecoins is like a payment or settlement use case is fantastic. And I think what we're seeing already, I think there's an example recently where China and Russia was using stablecoins and blockchains to settle oil payments cross-border. It's a good example of like how efficient blockchains are at sort of agreeing on things and just trading things away, because you don't need all of these weird integrations with local banks and local systems. You could just all use one global agreed upon centralized permissionless clock that says, okay, this transfer of stablecoins have been paid over here, and then that recipient can then go through the local banking system to offer up, for example. It just makes a lot of sense, especially with the dollar sort of being the world's major asset. And obviously, I think there's a lot of interest specifically within the US to sort of push this. And we're getting, hopefully quite soon, like regulatory clarity, which I think will make it a lot easier for banks and such to start to utilize this. I do think, and this is something that you're going to see a lot of, I think, is that a lot of these institutions are not going to interact with blockchains directly. I think that's highly unlikely. Maybe that's the end goal or end game where like the blockchain is just a settlement layer for anything and everybody interacts with it directly. That's not going to happen immediately though, I think. I think you're going to see intermediaries pop up that are going to handle different things. I think we even saw a law that was being proposed about you can't hold interest-bearing stablecoins, and in some cases no stablecoins at all, and you'll need somebody to sort of actually handle that and mint those and take care of all these things. Lots of boring accounting standards that has to be accounted for. So I do think we're going to see this sort of weird interim period where you're going to have a bunch of intermediaries that are not associated with any banks, because I don't think if I'm one bank, I'm not going to trust a JP Morgan developed thing or intermediary. I think you're going to see sort of third parties that are going to handle a lot of these things that you might want to deal with when you handle interactions with blockchains. But stablecoins, clear PMF, especially when it comes to cross-border transfers, hedging. It makes it easy for a banana farmer somewhere in South America to hedge his currency risk, for example. And it's just a great way to deal with micropayments of a lot of things. You take away a lot of the fees, which is obviously fantastic. I still think, sadly, on the on-ramping and off-ramping side, most of the companies in this space now are still, I think, straight up stealing money. The take rates they have are ridiculous. So there's still a lot of work to be done, I think, for a lot of these intermediaries to actually get people on and off to blockchains. And I guess like one caveat, I think a lot of people are not talking about this, but like the actual activity on like Tron for like USDT payments in areas that are not Europe and North America are extreme. Like it's kind of impressive to see this, and it really sort of highlights that there's real need for like a global clock that is permissionless and fast to use. And stablecoins have clear PMF there. I do think that's extremely cool.
You heard it here first. Maz says buy Tron. That's his big pick of the day.
I would never support His Excellency, but I will say he's built something that people utilize. And that's
very
what
true.
can be said, I think, for a lot of things. Say whatever you would think of him as a person, and the way he titles himself, His Excellency. But people are using it.
He's found more product market fit than most, if not almost all. One thing that you're talking about that I want to dive into just a little bit more, I think you spoke a lot to the payments use cases, USDC, USDT, but this emergence of these like yield bearing, I won't even call them stable coins, synthetic dollars. It feels like everybody's popping up right now with some sort of version of again, synthetic dollar that's got yield on top of it. So curious, again, what you're thinking about this kind of emergence. I think Athena really started this trend, but also just like, what is the difference between a USDC vault versus everybody trying to make it composable and turn this into like a synthetic dollar that has yield as well? Like, just kind of curious how you see those two trends playing out. This kind of vault roadmap or this synthetic dollar yield-bearing roadmap.
Yeah, I think what you're seeing is that there's this, and a very good sort of observation on the fact that a lot of these yield-bearing stablecoins are not stable. And that's also going to be the issue, as I mentioned earlier, with like the banking sector. I don't think they can hold these assets on their balance sheets in a lot of cases. It is great, though, especially for people that just want to hold an asset, a singular asset, and they don't want to take any smart contract risk, and they want yield to be paid out, especially if this yield is represented off-chain, or maybe it's an on-chain basis trade, but in most cases it's an off-chain basis trade, although there are examples of like, I think Resolve is doing some stuff on Hyperliquid and doing the basis trade on there, another one of these sort of yield-bearing stablecoins. But it's a good way to sort of incentivize the use of it as a currency as well. While on the vault side, you do have a lot more expressivity, but also a lot of, it's more for black box. But it does make it a lot easier to sort of spin up a new vault and do a bunch of cool stuff there. And then in a lot of cases, like even the lending of against the vault isn't that hard anymore. Morpho is doing it, I think Level as well, but Level also has a stable coin. And I think they're all sort of arbing the funding rates in between these different lending and borrowing protocols, which is kind of cool to see. I think there's very clear like reasons why you'd want an asset like this, right? It's easy to hold. In a lot of cases, the risk is pretty clear. I will say in most cases though, like you're gonna just see, at least in the vault case, it's basically a way to like make these interest-bearing stablecoins, but without it actually being it. So like most of the vaults are like USDC, USDT, which are not yield bearing by default, but you can do so much looping that you can make them yield bearing. But it has to be through a vault because they're not, being paid this rate by default, like an Ethereum is or Resolve is. There's like cool extensions of this. So like Resolve has like a junior tranche called like RLP, where you take like more of the risk, but because of that, you get more yield as well. So I think most of the vault examples of like yield bearing stablecoins are just because the stablecoin itself is not yield bearing, and this is a way to get around that. So that I'll say that's the major difference here. But very clearly, people want to hold assets that are quote unquote stable, and they would like to be paid for it, and preferably more than what they can get if it's not on chain.
Maz, something else we were talking about a bit offline was this kind of merger of like RWA credit space. And I think this Maker's been doing this for a long time, getting into private credit, but I think we're going to start seeing more of this, like this financing boom happen on chain. So what can you say about that? Again, you had a few ideas offline, but I think it'd be good to share as well.
Yeah. So obviously me personally, I'm not a credit expert. But luckily we have like Maven 11 credit or M11 credit, which is sort of our credit arm within the M11 group. We've grown a lot since I joined. I think when I joined we were 7, now we're 25-ish across like 4 different verticals. One of them being the credit side, right? And on this side, obviously we see a bunch of stuff happening. And that's credit on blockchains and in crypto has for a long time escaped us. And it is a clear aspect, the key aspect of like building society today. Most of the world is built on credit. Like everything, you look out the window, most of that stuff is built on credit. Especially if it's on the private side, but even governments, right? Governments also have a ton of debt and they want to take credit. So what you're seeing, I think, is that we want to bring this on chain, but obviously credit by default is not something that is permissionless or anonymous, confidential. Like you need transparency. You need KYC. You need promises of them holding X, Y, and Z. And I think most of the examples of like credit we've seen on chain have failed, at least under collateralized credit, right? Obviously we have lending and that's succeeded for a great time, but in most cases it's over collateralized. There's just so much risk, and you have to merge the off-chain aspects to the on-chain aspect of it. There are great things here like, zero knowledge proofs where I could prove that I hold X, Y, Z in assets, whether that's on-chain or on a centralized exchange and so on. You can merge that together and you say, okay, he might be able to pay for it. What I can't see is like, okay, maybe there's another creditor that has first access to the funds that he might have in a case of him going bankrupt. Well, I know he has the funds, I've given him money, right? But maybe it's Nomadic that actually has first access to these funds that he actually holds. So there's a lot of issues with how you'd want to sort of set credit up on chain. But that's been a good examples. I think this is starting to extend because you can do very efficient credit on chain, specifically because of the stablecoin aspect and the payment and the global clock here. So this could be like credit card companies like a Rain or others that are doing crypto debit cards. Maybe you want to tokenize the receivables and they want to borrow against this. That can be very efficiently done on chain. And it's something that I think we're going to see grow over time. Because I do think if we want to get credit, or at least crypto, to the next level, we do need sort of credit. Obviously, you can get terrible unwindings of credit, which is obviously bad. You want to avoid that. And the reason we don't really have a lot of credit now in crypto is because of the fact that it's so difficult to do this on chain. But I do think it'll grow. And I think especially with sort of the growth of stablecoin and payments, credit becomes a lot easier to do. The example with the receivables and tokenizing those becomes something that you'll actually start to see. So I do hope, and I think credit will grow in crypto over time, even though it has, I think, failed so far. I think like Wildcat, I think most people know Launch on Twitter. If you're on CT, you know Launch is building Wildcat. Like it's fine to lend out to people that you know and trust. Obviously, I think most people trust the attribute to be able to pay up when the time comes. Same with like a Selene. But extending this out becomes very difficult, right? So it becomes a reputation game there unless you can ensure and reinforce this. But we have technology like a CK where this might be so knowledge, where this might be useful. But I guess that's my outlook on credit for now. I think it's only going to grow, and I think it needs to grow for crypto to become much larger than it is for now.
I'll call out one project that I'm pretty interested in following. It's called 3Jane. It's kind of following this roadmap.
Yeah, CKTLS to sort of showcase that you would be able to borrow. But they would run into that example I gave earlier. So I'm looking at 3Jane on the back end right now for some DD. I think one example that you would run into, like, is that example where you might have first access. He can show he has the funds, but somebody else might have actually off-chain have the right to get those funds before him. Yeah. And then I think there's also some adverse selection in credit. So like if you can't get credit off-chain, maybe there's a reason for that. So why are you coming on-chain to get credit? So that's maybe also something to think about. That could be some adverse selection, unless it is just more efficient. There could be a world where it's just way more efficient to do credit on-chain. And obviously then you sort of get these actual people that you want to lend money to come on-chain as well.
Given that we're talking about credit and we've got Maven 11 represented here, Maple has been a team that Nomadic and I have followed and really admired what they've built, especially coming back from, obviously some of the challenges, the struggles of the 2022 bear market. So what are your thoughts there? Like what might they have learned about their original design versus like what they've evolved into? And actually, I might even be able to just summarize, like originally they did unsecured lending. So they were lending to crypto institutional type borrowers. And again, it was unsecured. As far as I know, there wasn't enough collateral to cover those loans.
Yeah, so it was under collateralized, right? You had different pool manager, I guess you would call them, like vault underwriters. So, for example, like an FTX would come in the trading side and they would want to borrow money and they would say, we can pay 15%. We'll put on some collateral, or they would showcase a balance sheet with some of these high FTV coins and say we can obviously pay back because we have maps on Solana. We could pay with that. Obviously, that didn't turn out that way. But essentially, what happens is that they put up some collateral and they'll borrow way more. But because they're paying such a high rate, 15%, like people will obviously want to supply dollars to this, because if I can be paid 15% on my dollars, that is pretty attractive. When one of these borrowers then end up failing, you have a massive issue, right? And that's sort of what ended up happening during the FTX crash. A lot of the market makers who were big users of Maple, and because they're doing strategies that are paying much higher than 15% and are happy to pay this high yield to borrow more money because the strategies are making way more. Many of these market makers were market makers with funds on centralized exchanges that went down, FTX being a good example, right? So when you have these humongous sort of industry-wide knockdowns, that can really throw a hurdle in the way it works, and that happened to Maple back then, sadly.
We got to talk through all these different like sectors that Maven 11 Fund 3 will focus on. Let's just bring it back to the standpoint of learning. You're a research partner, like your core skill set, like the most important skill you probably have is that clearly love to learn about this space. So for someone who's coming into the space new, what would be like one sector that you might recommend that they focus on? Like what might potentially give them some edge eventually as an investor? What's that one sector to learn about now in spring 2025?
I think to understand a lot of the things in crypto, you need to understand how blockchains work from the ground up. I think if you really want to like learn how a lot of these things ebbs and flow, both from like the technical, economical aspect of it, and I think that will enable your brain to sort of scan and see things that might be interesting for other people. I'll shout out Tim Roughgarden, who does some fantastic lectures on crypto specifically, with great lecture notes. There's great videos online. It's all free. But Tim Roughgarden is absolutely fantastic. and does some fantastic work in educating other people. I think if you really want to like be a market participant and want to see what interesting and new, you have to understand sort of the actual back end of how these things work. And I think obviously on mimetic coins and that sort of mania, that is not needed. You're just trading attention, and obviously that will continue to be a thing. But I do believe that if you actually want to understand how we can build better applications and do cool stuff with crypto, you do need to understand how these things actually work. And Tim Roughgarden does a fantastic job in actually explaining how these things work. So they're not very long. It's a couple of hours. You'll walk away with better knowledge of crypto than 99% of everybody else. And I think that gives you an edge, especially in both scouting what is a scam and what's not a scam, and what has a chance to do great. I would definitely recommend that.
What a great recommendation. We will put a link to, I think, Tim Roughgarden, just doing a quick Google. I believe he has like a whole YouTube of lectures. Is that right, Maz?
He does. And then you can, I think on his personal website, find the lecture notes. He's at A16C, also funded, does a bunch of research.
Yeah, we'll go ahead and link that in the show notes as well. And otherwise, I think this is a great place for us to start to wrap up. So I want to remind our listeners that they can learn more about Maven 11 by going to maven11.com. They should follow Maven 11 Capital on X, and then follow Maz's personal account at 0x Rain and Coffee. And then we'll put that into the show notes so you can easily reference it. Otherwise, Maz, thank you so much for your time. It's great to like finally get to connect and talk again. Nomadic and I have really admired, just like the way you guys do business. Like we really think the world of you, and it shows in the portfolio that you have. And we're always very excited to be investing in around alongside Maven 11. So we'd love to have you back in the future. But otherwise, any final word for us, or any like recommendation for folks that want to get in touch with you?
Yeah, I mean, thanks for the great words. I can only echo that. I remember seeing DeFi Dad tweets across my Twitter back then, years and years ago, always highlighting cool DeFi protocols to utilize. So yeah, if you want to get in contact with me, whether that's to do research together, or if you're building something within sort of the things that we talked about during the podcast, feel free to reach out to me. I'm always open to just discuss, even if you want feedback. I'm not looking for money. I'm happy to just talk with you. That's the way I found most of my friends, whether it's through online conferences, offline conferences, or through Twitter. It's just talking about crypto, because that's the one thing that connects all of us, even though we come from different aspects of life.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.